let's just talk about, for instance, Bitcoin, or actually let's talk about the ETFs first. They outperformed the S&P 500, and this was just a very quick analysis. But I keep hearing how they're a hedge. And one of the outputs in my research said, actually, within the last year, the correlation between cryptocurrency ETFs and the S&P 500 is like 90%. How is that a hedge?
Yeah, so what cryptocurrencies do is basically what investors want it to do. So in a lot of times, it's been a hedge against inflation. And right now we have very low inflation. So it's been acting like a risk asset. It's acted as a currency, as a risk asset, as a hedge against inflation throughout the years. And it's constantly evolving. Right now, the way that I see it is Bitcoin is a little bit more of a risk asset and is moving up in conjunction with really the NASDAQ. And that's what's really driving that asset price higher. Part of the correlation, though, does relate directly to M2 global monetary supply, which, by the way, most risk assets do as well. As countries begin to print more money, then equities go up, cryptocurrencies go up. So that's really why we're in a position right now where they're all moving together.
But okay, why would I do it then? If the correlation is, as you've just described, the volatility within crypto seems to be a downer, my term, as opposed to the more, there's not necessarily less risk, but the more stability of the old and tired asset classes.
Yeah, absolutely. So even though it is performing like that, it does perform at a higher beta than most equities. So for instance, if you look at just Bitcoin versus most of the equities that are out there, it's up over 150% over the last year. Not many equities are. So even though they're correlated and moving in the same direction, the beta is much higher. So you're getting a lot more rocket fuel in this nascent asset class.
I want to ask you some questions about stablecoins, because we have the Genius Act has passed, and the critics of all of this are saying that stablecoins, quote, the term stable, are pegged to currencies like the US dollar. And when I heard the word stable, I'm old enough to remember Bear Stearns, and I looked up the name. It was the High Grade Structured Credit Strategies Enhanced Leverage Fund. Sounds really good. And it went belly up in the summer of 2007. I remember that. There's a great comedy routine about it. It's like, oh yeah, leverage, that sounds good. High yield, that sounds good. Stable sounds good. Stable coins can be depegged from their currency. And the critics are saying that allowing stable coins, allowing banks to issue stable coins and allowing me to present the bank with Ether or whatever cryptocurrency is collateral will only introduce risk to the financial system, which would lead us right back to 2008 and the great financial crisis. How do you respond to them? Is it capital controls that will prohibit that? How do we protect the rest of us?
Well, first of all, I agree with you. Second of all, capital controls are really important here, and that's part of this bill. So there are a lot of different stable coins that are out there. The way that I think about it is most people have a Venmo account. So you trust Venmo enough to know that if you put money on it, they're holding that money. And by the way, they're not just holding the money, they're investing it in treasuries, particularly short-term treasuries, so that they can make money by holding your asset. And that's one of the ways that they make money outside of advertising. So when we're moving money between each other via Venmo, we trust that that's there. We trust that it's collateralized, and it's collateralized by bonds after we put the money in. Stable coins are much the same, even the same as banks, because banks are taking your cash, they're lending it out, they're creating debt instruments. Silicon Valley Bank went down because they were doing too much venture lending and too much lending in areas that were either highly illiquid or really long duration. What stable coins are doing is they're taking your dollars, they're putting it in mostly treasuries, and in some cases, they're even giving that yield back to you. So it sort of works as a hybrid money market mutual fund and a hybrid digital currency, much like Venmo.
But let me start. Okay, so you tied it to U.S. Treasuries, but if there's a run, let's call it crap coin. There's a run on crap coin. Somebody's going to have to start selling those stable coins, those treasuries, to generate revenue to pay out the run, which is going to depress the value of the currency or of the treasuries. And how do we avoid, when you said, I agree with what you said, I'm not sure you do, or maybe you do. I think
I absolutely agree with what you said.
So I think we're going to have a collapse. I think we're really setting up. It's not large enough yet, but I think the banks will start packaging the cryptocurrencies that they're being given as collateral into tranched bullshit, investments that they'll sell to people in foreign countries. It's 2006 and 7 all over again. Or am I wrong?
Yeah. So, and again, it all depends on what instrument you're talking about, right? So broadly, yes, I do agree with you. There are differences between various stablecoins that exist. Some of them hold either highly illiquid securities or not securities. Well, sometimes securities and sometimes very volatile underlying assets. Some of them are really plain vanilla, right? So Tether, for instance, is actually in the plain vanilla camp of holding a lot of very short duration US treasuries, including T-bills, which are pretty liquid and easily sellable and easily put back to the client. Circle's USDC isn't too dissimilar from that. It's holding mostly US treasuries, mostly T-bills. There have been stable coins that don't do that. And those actually have crashed. We've already seen that happen. One of them was Terra Luna, that very famously was promoted by Michael Novogratz. If you remember, he got the wolf Luna tattoo on his arm and was one of the big investors in it, and then it collapsed. So the reason why it collapsed is it held a lot of things like Bitcoin instead of boring things like treasuries. And when there was a run on it, a lot of the assets that it was holding was either undervalued or illiquid, and it completely collapsed.
And is there any protection now that we've opened up the floodgates for stable coins and cryptos as collateral with the banks? Or are you telling me, and again, I'm going to ask you in simple English for a Luddite, 8 years from now, are we going to have another crisis?
Well, it all depends on which stable coins that people are investing in and what guardrails are around them, and it also depends.
Are there guardrails now, though? If a U.S. stable coin, but there's a run on the collateral that was given to the bank or the institution, there'll be shadow banks to get you that stable coin. You're still going to drive down the value of the stable coin. The underlying asset is what's at risk here.
Well, I look at it like a money market mutual fund, right? So even some of the money market mutual funds stretched out a little too much.
Yeah, we broke the buck in 2008.
Exactly. And some of them stayed pegged to the dollar. So it all depends on the person that's analyzing the underlying. And if people are just willy-nilly saying, yeah, I'll take this stable coin because it yields more, rather than actually doing work and deciding that, oh, this is highly liquid, it's got very short duration, it's got assets that are able in almost any environment to be able to be sold and dollars sent back to the client, then you're going to be fine. But if you're somebody that's not doing your work, then just like a money market mutual fund, you're going to have issues. And in the US, there are now guardrails, but there's also stable coins that aren't regulated in the US and they're outside of the US. And that's something to be wary of.
The shadow stablecoin banking system, is that the term we're going to be using? Because
Absolutely.
what I'm hearing you saying is, yes, we're going to, because even if you have guardrails, we had guardrails in 2005, 6, and 7. Didn't matter because the stuff was tranched and broken up into derivatives of bullshit that were sold to idiots.
That's exactly right.
Most of us were the idiots.
Yeah. I was trading bonds in that period of time. I know exactly. I mean, and not just bonds,
Okay.
esoteric bonds.
So let me come back to Canary Capital. Because this stablecoin discussion is going to be a much broader discussion, I'm sure, as we go forward. You've asked the SEC. You're going to be offering an injective token ETF. What is that? Again, total idiot when it comes to this stuff. In English, an injective token. I'm thinking about those old wax figurines as kids we used to get when you went to Disney World.
Yeah. So here's the way that I like to think about a lot of these, what I call protocol tokens. So Bitcoin truly is money. It's digital money. Most of the other tokens that you come across, like Ethereum, Solana, Injective is a good example of it. These are protocols. And what that means is, almost everybody has an iPhone. And when you're bored, you download a game and you might play that game, and then you run out of time on the game, and you've got to either use the in-house currency to buy more time or to buy more things to continue that game, right? I mean, that's a common thing that a lot of people have experienced. All a protocol is a platform in which applications are being built, but instead of each game having their own in-house currency, there's a currency for that platform that can be utilized across all of those applications. So it's a common currency wrapped around all the applications that are running on that network. So imagine Apple, instead of each game that you download or each app that you download, each having their own in-house currency, imagine there being an Apple coin that works on anything that you do on the iPhone.
And the injective token is the technology that allows what I would call the old American Express office in Europe, where you had to cash in your traveler's checks.
That's exactly what it is. It's American Express traveler's checks. They can be used in any place that is accepted. So imagine it as a technology platform, applications on top of it, and you can use it on any of those applications.
How do you make money on that? Or does each transaction kick off a minuscule, amount of value somehow that with scale you actually make some real bucks?
Yeah, that's exactly what it is.
I'm going to let you have the last word because, and I want to have more discussions with you because I do find crypto fascinating as an observer. I'm terrified of what it's going to do to my retirement because I see a collapse coming based on it, having lived through 3 already in my lifetime. But you get the last word.
Yeah, absolutely. Well, I'm just very excited that we've got a new SEC administration in place that's moving things forward from a capital perspective, and that we're able to begin to launch some of these ETFs, that we're able to really explore in a lot of areas like stablecoins. So, guardrails again have to be in place, and investors have to be smart. But we're very excited that innovation is back.